Okay, so let's go ahead and get started. Hello, everyone. This is Kathy Lien with BKForex, and I'd like to thank all of you for joining me today. I've just closed the chat box. I think that everything should be coming through okay in terms of the sound as well as my screen. So if you have any questions about what I'm talking about today, please feel free to type your questions in, but I won't be able to see them. I'll open the box occasionally, but I really won't be able to see them because the box is closed. So that means that we'll get to your questions towards the end of this presentation. Okay, so the topic today is kind of vague. It's 3 ways to trade Forex. And I like this topic quite a bit because it does allow us to cover any type of ground that we want. And what we will do today is we'll talk about 3 different strategies or techniques to look at the FX market. So before I begin, I like to share with you this disclaimer, which says that trading Forex carries a high level of risk and may not be suitable for all investors. For those of you that are watching this video on demand, I encourage you to pause the screen, read through the disclaimer thoroughly before moving forward. Just a quick question to FX Street. Is this being recorded? Because I know I'm going to get this question as we go through. So great. It is recorded. So if you want to rewatch something, didn't hear something clear enough, don't worry. You can always watch the video again and be able to look at it to review all the topics that we covered. Okay, so we're going to start off by talking about day trading and why is day trading so popular? Well, a good reason why day trading is so popular is because, the FX market is, or one of the main reasons why day trading is so popular is because the FX market is a truly 24-hour market. So there's something going on at all times of the day, which can be good and bad. It's bad sometimes because it means that some of the price action can happen while you're sleeping. It is good because it means that regardless of your time zone or your lifestyle or your the time that you have to trade, most likely you'll get the opportunity to do so. So, that's really the key, which the FX market is open 24 hours a day. So this begs the question, who is suited for day trading? Well, I've got a couple images here of different types of people. And basically, the people who are suited for day trading are people who have office jobs, who can be around their computer, at various times of the day, like, for example, maybe an accountant or something like that, or a doctor or a dentist who can periodically go back to their desk who've got, a fairly flexible job. They can go back to their desk and check to see whether or not they have trades setting up or how their positions are doing and, so forth. What type of person is not suitable for day trading? Well, the types of people who are not suitable for day trading are basically people who cannot have easy access to their computers. Of course, this is changing these days because of smartphones and everything like that, but still, there's nothing quite the same as being able to watch your trading screen and watch the charts as they actually happen, because when you are using your smartphone, you're still pulling the information and not necessarily push the information to you. Of course, if you are super sophisticated, you can code and get certain prices pushed to you, but still not the same thing. So how do the pros trade? Well, first and foremost, the pros are basically what we're talking about is the people who trade on the prop desks of banks and so forth. Of course, that's starting to evaporate as well, but those are the type of people that we're generally talking about. And And they usually follow, one of these different types of trading techniques, which, we'll try to address some of them. Basically, these are bank traders who usually trade very short term. And the reason why they trade so short term is because, first of all, they are, they've got a very stringent risk desk who, they keep a very close eye on what they, type of risk that they take. So obviously, they don't try not to take, an excessive amount of risk. And then along the same lines, they are glued to the computer screen. And as a result of the fact that they're glued to the computer screen, they, are trading, very short term. They don't like to hold positions overnight. So typically bank traders will either trade institutional client flow, which, obviously you and I are unable to do because we don't have the benefit of sitting on a prop desk and hearing all of the institutional flow coming in. They will trade for the next pip. Typically what that is about is, basically those algorithmic trading programs who just go for the next pip or micro pip move in a currency. So basically, that's also something that we're unable to do on our end. They may trade new highs, new lows, which we are able to do. We are able to trade new highs, new lows. And, I've got this trading strategy that I may have shown you in the past, which is called the 1% break. We're not going to look at that today, but we do have a trend strategy called the 1% break that allows us to trade new highs, new lows if necessary, and event-driven, which we will talk about today. So, a lot of our strategy is focused on trading breakouts. So, why bother, the question is why bother with breakouts if currencies tend to trend or range 70% of the time? The reason is because breakouts can lead to massive moves. We've been seeing that in the markets lately where, for most of the summer, we had pretty consolidated price action in the major currency pairs, and then now we're in breakout mode for most of the pairs. So, very different market environment that can come and go. And so, that definitely creates some type of trading opportunity. Breakouts can be readily identified on the chart, which a lot of people love. And breakouts are an integral part of speculative markets. So there are two primary drivers of breakouts, news and price. And so in terms of news, that's basically what we're going to be focusing on. Because with news, that really, is the main trigger for some of these explosive price actions in the markets. So there are two ways that we suggest trading news. The first way is to wait 5 minutes and to wait for the candle break. The first way is to wait 5 minutes. The second way is to wait for the candle break. This is not to say that one is more effective than the other. Both of them can be traded effectively. It's just a matter of your trading style. So starting off we'll take a look at 5 minutes first. Both of these are reactive trading, which means that you wait for the economic data to come out first before you take the trade. And with reactive trading, the most important thing is that it requires swiftness. So with waiting 5 minutes, what you want to do, and we do this quite a bit for our short-term trading strategies. You wait for the data to come out. You wait for 5 minutes for technical confirmation. And what that means is that if the data is good, you want to see a green candle. If the data is bad, you want to see a red candle. You want to see the currency pair close weaker. Because if it doesn't do that and it does something different, like if the data is good and it closes red, that means that something else is probably going on, and that you don't understand, and the market doesn't care about the number. Or alternatively, if it closes green and the data was bad, same story. The market may not have cared about the number, or may be focusing on something else. So you want to wait 5 minutes for technical confirmation on the charts. So this is an example. In this example here, we have Australian PMI Manufacturing Index release. This is 5 minutes, 5-minute candle. So the Australian PMI Index is released. You see that the 5-minute Aussie dollar candle does close green, which is pretty much exactly what we want to see. So the candle closes green, and that indicates to us that it may be time to trade. So with this type of strategy, we have the following rules: 20 pip target, 20 pip stop, and this is the trade where we take a look at the currency pair. You see the 5-minute candle closes green, so you go long at 91.45, 25 pip stop, 20 pip stop, 20 pip first target, and you can see we exit the trade about 2 hours later at 91.65. Here's another example: USQ1 GDP, where the number comes in weaker. You can see the 5-minute candle closes very much in the red. So it closes very much in the red. You go short, even though it's a red candle. So you go short at 97.44 with a stop at 97.64, targeting 20 pips at 97.24. And usually with every single type of strategy, we like to show winners as well as losers. And so as a result here, you see that you're going long the currency pair. You're short the currency pair at 91.37. Stop is 91.57. Target is 91.17. And I think it's important to look at these in terms of both the winners and losers, because it's important to have a little bit of a reality check and realize that you can both win or lose in this type of scenario. Now, the variation to this is to wait for the news candle break. So what does it mean to wait for the news candle break? It's a very similar type of trading technique, but what you're doing instead is you're focusing on the data candle and not necessarily on just how the candle closes in the first 5 minutes. So same story, you're waiting for the 5-minute candle to close. So you're waiting for the 5-minute candle to close, and you can see that basically, let me pull up the 5-minute candle example. We've got the same type of rules: 20 pip target, 20 pip stop. And let's take a look at some examples. So the same examples here, where you go long Australian PMI index, and instead of entering the trade, instead of entering the trade immediately after the 5-minute candle close, what you do instead is you wait for to place an order to buy at the high of that candle. So we would buy instead at 91.50, stop at 91.30, target 91.70. And in this case, we would have gotten a slightly worse fill, but trust me, there are examples where this would have saved you from a negative trade, and that in of itself would have probably been worth it. Here's another example: Canadian GDP. In this case, now this is an interesting scenario, which is that what happens here is that the data is weaker, but dollar CAD actually falls. So the data is weaker, dollar CAD actually falls. So normally you would think, okay, I'm not going to take this trade, which, is fully understandable. But in this example here, you have the opportunity to take this trade. And the way you have this opportunity to take this trade is you basically wait for, you place your orders at the high of that candle because you know it's a CAD negative number. So you wait for it to reverse. And this is very characteristic sometimes of CAD, which tends to have which can have a delayed reaction to its economic reports because there may be U.S. data being released or something else going on. So in this case, you place your order to go long at the high of that candle, which is 104.93, a stop at 104.73, target 20 pips above, and you exit 20 pips below that. So, this is an example of how you would have caught a trade versus completely missing it. And then, of course, we always like to show winners as well as losers. So that's what we're doing right here, which is we're showing you a loser in this case where, in this case, you would have still gone long dollar CAD because obviously the data was very, very weak. But you would have been stopped out within the first 5 minutes, which is fine because that's why it's important to have your stops in place. So the next trading technique that I want to show you is how to join a new trend, which I think is also very, very important. Okay, so how to join a new trend. Now, this is one of my older trading techniques. I've actually, recently, if you're on our homepage, you'll know that we actually turned this into a version of this into an EA. So if you're interested in getting that, just email me at Kathy@BKForex.com and I can send you some information on that. All right, so anyway, we've had a lot of opportunities to join new trends lately. And the reason why we've had a lot of opportunities to join new trends is because we've had a lot of breakout moves in currencies. And one of the techniques that you could have used to join the new trends is the following. So what you want to do is I love to use double Bollinger Bands, and I think some of you may have been familiar with the double Bollinger Bands that we have used in the past. So what you want to do is you want to use 2 sets of Bollinger Bands, 20 period 1 standard deviation and the 20 period 2 standard deviation Bollinger Bands. So what you want to do in this case is you want to look for the currency pair to close above the first standard deviation Bollinger Band in an uptrend. So this is what it looks like. The currency pair is originally in kind of the range trading mode. So it's originally in the range trading mode, meaning that it's below the first standard deviation Bollinger Band. So just to clarify a little bit, the outside lines are the second standard deviation Bollinger Bands. The inside lines are the first standard deviation Bollinger Bands. And as a rule of thumb, I like to say that if the currency pair is trading in the 1-2 band and the upside, it's in the buy zone. If it's trading in the 1-2 band and downside, it is in the sell zone. So you can see that the dollar yen, where the arrows point is where the currency pair has just entered the buy zone. And that's what we're basically looking for. We're basically looking for the euro dollar to go from the range trading zone and then pierce into the buy zone. So each of the pierces that you see on this chart are indicated by these arrows. When you see that happens, you see that the candle closes above the first standard deviation Bollinger Band in an uptrend. Then you go long at the next candle. So you go long at the next candle, and the second arrow in this chart shows you where you would go long. So you go long at the next candle with a stop 15 pips below the first standard deviation Bollinger Band. So if you take a look at this following chart, well, actually, I added the exit rules first. You want to target 1 times risk and move your stop to break even. once you've achieved 1 times risk, and then trail your stop on the remainder of the position. So actually, I think I skipped the rules here, but let me show you some live trades then. All right, so some live trades, like for example, let's just start with the euro. Here's a good example right here. I hope you can see my chart, where we were previously in the range trading zone. Currency pair dropped below or pierced below the first standard deviation Bollinger Band, and your risk, so your close would be 135.68. The first standard deviation Bollinger Band was at 135.88. So let's just round that up to 90. So that means that your stop would have been at 136.05. So your target is 1 times risk. So 05 was your stop. You're getting in at 67. So that means that you're basically risking 38 pips on this trade. Next day, it does fall about 90 pips. So obviously, you would have exited half of your position at this point, move your stop to break even, and then you can trail your stop using the Bollinger Band and exits, somewhere around here, I think. Dollar yen also did that recently. Here's a pierced trade, closed above the Bollinger Band. You definitely would have hit T1 on this candle. And then when it does it again over here, you would also take advantage of this move. When it does it over here, you would also take advantage of this move. So these are all examples of pierced, and even on the short side. If you got right over here, you take advantage of the short. This one you wouldn't have stopped out, which is fine. This one you may have survived it, but we'll see. This one you would have actually made a profit. So while there are some losers, there's certainly more winners than losers. Now we can also use the Bollinger Bands to trade on a shorter term basis. One of my favorite techniques to do so is the extreme fade strategy. And what this does is basically use the Bollinger Bands on utilizes the Bollinger Bands on a shorter term chart, more specifically the 15-minute chart. But of course, because we're using the Bollinger Bands on a shorter term chart, we have to use slightly different Bollinger Bands. So in the previous examples, I showed you how we use the 20 period 2 standard deviation and the 20 period 1 standard deviation. In this example here, with the extreme fade strategy, we use the 20 period 2 standard deviation Bollinger Band and the 20 period 3 standard deviation Bollinger Bands. And unlike the pierce strategy, where we're looking for the currency pair to move into the buy zone or the sell zone, with this technique, what we're looking to do is we're looking for the currency pair to come out of it. So this is actually a fade strategy, whereas the other strategy was a new trends continuation strategy. All right, so what you do is you basically, with the strategy, you wait for the currency pair to rally, and what it does is it fades extreme. So you wait for the currency pair to rally, close above the 3rd standard deviation Bollinger Band, but just because it closes above the 3rd standard deviation Bollinger Band does not mean that it's time to take the trade. Instead, what you do is you wait for the currency pair to turn. So you wait for it to drop back below the 2nd standard deviation Bollinger Band. So in this case, you see that it closes above the 3rd standard deviation Bollinger Band. It rolls over, closes back below the 2nd standard deviation Bollinger Band. Then you go short the next candle, targeting the Bollinger Band on the other side. But you could also target 2 times risk. Here's another, and your stop should be at pretty much the high of the swing high. So here's another example. You see the currency pair rally, close above or at the 3rd standard deviation Bollinger Band. You go short. Your stop is pretty much at the swing high, and then your target is 2 times risk. And so just another example here. And this is really good because currencies, while, it's very tempting to trade an overspot, oversold condition, oftentimes it's very hard to figure out when the currency pair is overbought or oversold, because oftentimes it will get there for a reason. So in this case, or because of a news event or something. So in this case, what you do instead is you wait for the currency pair to exhibit weakness to you first. And so once it's exhibited weakness, that's the point that you want to fade the move. And that's why we use the second standard deviation Bollinger Band as a filter. So here, once again, you will see the currency pair rally. It obviously closes above the third standard deviation Bollinger Band, but we don't enter the trade until where my candle points to. So that's where my candle points to, and that's where we want to enter the trade. And of course, there's always winners as well as losers. So what you're seeing is an example of a failed trade, because I always like to give a little bit of a reality check to everyone, so they realize that it's not all strategies work 100% of the time. So we looked at a lot of different types of trading techniques and trading strategies. So this begs the question, what day trading style is right for you? So I think it really depends upon your lifestyle and how much time you have to trade, because the event-driven strategies, for example, are really great because you know exactly when the events are coming, and so you don't need to be glued to the computer screen. So you may perhaps just trade right around the news events. For those of you that are that wants short-term trades but off of daily charts, then you may want to consider the Pierce strategy that I just mentioned to you. And then alternatively, if you like to pick tops and bottoms, that's just kind of your natural inclination, then you may want to consider the other technique, extreme fade, for example. Okay, so I talked a lot, shared a lot of different trading strategies. One of the strategies, the extreme fade, is discussed in more detail in guide number 3. So the one thing I just want to leave you with is, some free stuff. We've got a lot of guys who put together in the past. If you go to this link and you go to free stuff, you can just put your email in and you can get access to all of the guides and everything that we put out, and that includes a lot of what we discussed today. All right, so now I would like to open up the floor to any questions that you may have or any charts that you may want to look at. So I do have a question. Is there a standard chart package or platform that bank traders use? They like to use EBS and Reuters for trading. In terms of charting package, it really varies. There's so many charting packages right now, so it really depends on the actual person. But there's no standard. Although a lot of people like to use Bloomberg charts just for data perspective. So Aussie dollar intraday, if you take a look at the Aussie dollar chart, you can see that the currency pair is just kind of stuck in a broad range. Very little reasons for it to break out of the range this week, because we really don't have much in the way of significant Australian data. But in the grand scheme of things, I think that Aussie should be trading higher. If we look at a shorter term chart on a 15-minute basis, you can see that the Aussie dollar is very strong. And this may create an extreme fade opportunity, because we haven't closed below well, actually, I have different Bollinger Bands. I have the 20 period 2 standard deviation, 20 period 1 standard deviation. Let me add in the 3rd standard deviation, see where we're at. So we actually don't really have an extreme fade opportunity yet, but we did earlier last night, and that provided a nice little opportunity. But keep an eye on it, we could. We really don't, I don't really follow DAX. I would have to boot up a different charting package to do that. But stocks are doing well, and I think that that seems to, you'll see that the DAX is performing okay as well. So we're talking about FX exclusively. If you have questions about FX, I'd be more than happy to answer them. On our moving average, we use the 20-period SMA. How do we choose a broker who does not have slippage? I don't think a broker that does not have slippage exists. But do your due diligence. I think FXtree is a nice little broker comparison page that you can look at. Do you ever wait for a slight pullback? It depends on the trading strategy. Right now we don't. We really go with the momentum more than anything else. Do you think traders are waiting for Draghi next week? I think they are just waiting for next week because we really don't have much going on in the way of big market moving data this week. So next week we have a lot going on. Every month we have a week where it's quiet, and particularly because with the Labor Day holiday, this will be more quiet than usual. So yes, I absolutely think the market's waiting for next week, and made even more so because of Draghi and NFPs. Yeah, so the breakout strategy, sometimes we use the 20. I use the 20 SMA just for to look at on occasions. Euro Aussie, yeah. So we've been bearish Euro Aussies for some time. This is not a daily chart. This is a daily chart, and we actually caught this pierce move here. And if you're familiar with our trend capture trade, we've been buying this one for some time. And, so it's at the lows. I think it's headed lower, if that's your question. What did I like about shorting Aussie? Well, the reason why I didn't like shorting Aussie is because it hadn't quite satisfied extreme fade rules. So right now it's just been strong short-term move higher. So there's no reason other than perhaps you want to short the Aussie for me to be bearish, to think that it's going to top out soon. But in the grand scheme of things, it is range bound, so that's important to be cognizant of. Euro dollar. So yeah, I mean, euro dollar remains weak. I think first of all, everything's kind of really oversold lately. So I wouldn't be surprised if there is a little bit of a bounce. But fundamentally and technically, the euro dollar could get down to 130.25. We've got a big fib level. Sure, you guys have seen this. The fib level is drawn from this low to this high. So the fib level is right at 130.20-ish. It's the 50% fib, so that's kind of where the currency pair could head. Pound dollar, I think pound dollars, I've been calling for a bounce in the pound dollar. I mean, BOE is leaning one way, and I think eventually data will follow them in that direction. And on a quiet week such as this, where we have no UK data to threaten the move in the pound dollar, I do think that the currency pair could be could see a further bounce. If you download the free guide, we only have a limited amount of time. I mean, that was re-explaining the Bollinger Bands required me to go through the entire example, the entire presentation again. So if you go to this link, trading.bkforex.com/free-stuff, the short-term euro-dollar trading strategy goes over how to use the Bollinger Bands in more finite detail. Any other questions? Okay, I'm only going to look at currency charts. I don't have commodity charts on my charting package, so it's going to take too long for me to pull those up. All right, so if there are no additional questions, I'd like to thank all of you for joining me today, and I want to wish you all a great trading day.